Welcome everybody, and thanks, Pearlie. Before we get started, to our partners in today's webinar, ABL, KPMG, and the Israel-Australia Chamber of Commerce, just wanted to thank you all, and specifically to Jonathan Ortner and Harel Tow for being willing to share their wisdom. As Pearlie said, I'm originally Australian, been in Israel for a little over 30 years. Studied law at Monash, don't practice as a lawyer, and then after being a little while in the law, moved to Israel, and I've been in the family office for the last 25 years. We run a multi-family office here at Gold Rock. We're a trusted advisor to a group of high net worth families, both in Israel and outside. And one of the things we've spent a lot of time on is helping people transition countries and specifically make Aliyah. Obviously, when considering Aliyah, tax is a very large driver, and a lot of the things that we're going to talk about today are in fact tax related. But then it's not the only consideration, and I'm going to focus on some of the other elements, specifically the financial ones and associated issues. I'd like to start, well, I'm going to speak for about 15 minutes. Each of the panelists will do about 15 minutes, and then we'll have the Q&A. If you have questions, as Pearlie said, just type them into the chat here, and then we'll try and address as many as we can. As we're going through this presentation, I want everybody to keep in the back of their mind that this does not only apply to where a wealth creator or an adult is making Aliyah. It also applies when children and grandchildren are making Aliyah, and that is because of the niceties of the Israeli trust law. And so as you're thinking about this, if you have family members, younger family members considering making Aliyah, many of these issues are going to be of relevance. We're going to focus on issues which are specifically relevant to high net worth individuals, but of course, many of them are also relevant to everybody. Okay, when to start preparing for Aliyah? My advice generally, our advice generally, is to start thinking about things 18 to 24 months before. You don't want to be doing your planning in a rush. Giving that period of time enables you to maximize or explore the maximum number of options. Get your advisors to talk to each other, appoint the appropriate advisors, and we have two excellent tax advisors here on the line, and get them to talk to each other and coordinate over a very long distance with two very different tax regimes, and also build a comprehensive plan. Giving yourself the maximum amount of time also enables two other things. One is the potential for asset realization. As you're moving country, it may become wise to consider selling an asset or multiple assets. Not common, but it is something that you should certainly consider. It also enables the establishment of, or the changing of structures in advance if required. It enables discussion and maybe even negotiation with other family members and other related business partners, particularly if you have joint trusts with them. It also opens up the possibility to make an approach in advance to the Israeli tax authority for a ruling. This is not something that can be done quickly, and therefore giving yourself enough time to prepare is actually very, very wise. What does it mean to make Aliyah? This is an important point which I'd like everybody to focus on. In Israel, there are in fact two types of Aliyah. There is Aliyah for the purposes of the Interior Ministry, and there is Aliyah for the purposes of the tax office. Making Aliyah for the purpose of the Interior Ministry is when you go in and you get yourself an Israeli ID number, and you become a citizen of Israel. You're entitled to a passport, you're entitled to vote, etc., etc. You may be entitled also to various Aliyah rights around imports and things like that. However, that is not the same thing as Aliyah from a tax perspective. The Israeli tax authorities, without getting into the details, maybe Harel will touch on this later on, is when you move the center of your life to Israel. And that is not connected to the question of whether or not you took out citizenship or not. To give an example, or somebody coming here for a trial year, spends time just enjoying life in Israel, doesn't take out citizenship, and then a year later decides actually this is a wonderful country and a place they want to live. and decides to stay, gets their Taudat Zehut, passport, etc. From the perspective of the Interior Ministry, you've now made Aliyah. From the perspective of the tax office, you may have made Aliyah a year ago. And given the fact that there is a 10-year tax holiday, which we'll talk about later, this can be very, very relevant. The other thing is that if you've been spending meaningful time in Israel prior to moving here, that is also a factor that you need to take into account and something you should be speaking to advisors about. So that's on the question of when to begin preparing. The second is a question of currency. So from the perspective of an Australian, as many of you who spend time or have spent time in Israel knows, the Australian dollar fluctuates against the Israeli shekel quite rapidly, or in a quite volatile manner. Over the last 15 years, it has been as high as 4 shekels to the Australian dollar and as low as 2.2 shekels to the Australian dollar. And this has a range of implications. Firstly, obviously for spending, secondly for home purchases for you and potentially for other family members, and lastly, and perhaps most importantly, for your investment portfolio. It is not unusual in my experience for Australian families to have investment portfolios where 90% or more of those investments are in Australian dollars. Moving to Israel with a portfolio that is so heavily weighted into Australian dollars makes very little sense. And so diversification away from the Australian dollar is an important target. Something that should be done gradually, something should be done over a number of years. You want to be averaging the rate of exchange. You don't want to be taking a specific rate just because that's the day you happen to move or the day before you happen to move or afterwards. And you want to be taking advantages of the regular spikes that do happen in the exchange rate. And the other element of this is that you need to start thinking about your reference currency. For Australians, the Australian dollar is the dominant reference currency for very, very obvious reasons. That's the currency in which you spend. It's an island nation far away from the rest of the world. And so other than when people travel, it's very relevant, or people that are in the import-export business, very irrelevant what happens to other currencies. But once you move to Israel, having Australian dollars as your reference currency becomes less and less relevant over time. You're no longer spending in Australian dollars, living in Australian dollars, and frankly, your future and the future of your family has very little to do with Australian dollars. And so when you think about your investments, the performance of those investments, the currency balance within them, you should be thinking about potentially other currencies, and the two most obvious ones are the US dollar and the Israeli shekel. In terms of your investment portfolio, so one of the things you need to consider as you're preparing for Aliyah is whether your investment portfolio is appropriate. As I mentioned before, 90% Australian dollars is not so appropriate, but also you need to start to consider the tax implications. There is the 10-year tax holiday, which gives massive advantages for investors to build and compound returns in a tax-free way during that 10 years. Clearly, leaving assets within Australia would be a problem in that sense. And so one should start to consider potentially having assets outside of Australia. You need to consider how your real estate holdings will be taxed both during the 10-year tax holiday and afterwards, and what the implications of those might be. One needs to consider whether the portfolio managers that you have, to the extent to which you're using portfolio managers or funds in which you've invested are appropriate post-Aliyah. Are they the right currency? How will they be taxed? You need to consider the balance of your portfolio between various currencies. And you need to consider whether or not it's worthwhile to be investing in Israel during that 10 years. Very often it is not worth investing in Israel during those 10 years, simply because that won't be covered under the tax holiday regime. Next, I just want to touch on Israeli bureaucracy. It's very important to manage expectations when dealing with bureaucracy here. It has improved massively in the 31 years that I've been in Israel, but it is foreign, in literally and figuratively. It is mainly in Hebrew, and it is very, very different to Australia. It's very important for you to get good information before you come. Questions as simple as driver's licenses, professional licenses for people that need that, You need to choose a health service provider, a Kupat Cholim. There are 4 in Israel, Maccabi, Clalit, Me'ochedet, and Leumit. While thinking about health, you need to think about the insurance system. Israel has a 3-tiered health insurance system. Basic care, which is very good basic care, is offered to every Israeli citizen through the Kupat Cholim system, and also through access to the hospital system, which is free or very, very low cost. But on top of that, there are 2 additional layers of health insurance. One is extended Kupat Cholim insurance, which is offered by the Kupot and gives you things like choice of doctor. And the last one is supplementary private health insurance. And for those that are coming with pre-existing conditions, it's worth considering in advance whether or not you're going to be able to get that insurance, and make sure you don't have any surprises when you get here. I'll mention very, very quickly as we're talking about bureaucracy, that there is a very big difference between the ATO and the ICA in the way that they approach things. The Australian Tax Office tends to be sort of rule-based, where the Israeli Tax Office tends to be far more around. They look at the substance of the matter and not necessarily the form. Maybe Harel and Jonathan will touch on that. Lastly, from me, just a word on banking. Obviously, coming to Israel, you will need an Israeli bank account if you don't happen to have one already. It is much better to work with the private banks in Israel if you can. They generally have minimums, but they offer personalized service, which the Israeli banks don't have. We tend to typically work with one of the 2 big banks, which is Hapoalim or Leumi, with their private branches, although the others are also okay. For those who want to be independent and do your online banking the way that you would in Australia, one of the banks, which is actually the First International Bank of Israel, and UBank, it's actually the same bank, probably has the best English interface, the most user-friendly interface, so you might want to consider that for your general spending. It's a good idea if you can to open an account before you arrive, get a credit card before you arrive, if that's possible. Having that will enable you to get access to a whole lot of very useful online services. So to park your car with Pango, to pay with Bit and Paybox, which everybody uses here as currency transfers. For the purposes of investing, it is generally good to have an international account, an international non-Australian account. That could be Swiss, Channel Islands, Singapore, because that will enable you to both do passive investing during the 10 years without falling foul of either Israel or Australian tax. But you should just be a little careful around fees. So that's it for me. I've tried to keep this very, very short and hopefully very practical. And those of you who have questions can then type them into the chat, and I will try and answer them towards the end of the session. And so now back to you, Pearlie.
Thank you. Okay, we are going to move on to Jonathan. If I'm going to share a slide as well, so if there's any issue or you can't see something, please just send me a message. Thank you, Jonathan.
Thanks, Pearlie, and thank you, Darren. So 15 minutes for Australian cross-border taxation isn't that much. So what I'll do is try and hit on some of the headline points that you need to be thinking about, and that way at least you understand some of the issues that you might need to take to your advisor, accountant or lawyer to start the conversation, as Darren said, well in advance of making your move to Israel preferably. So Pearlie, are those slides up on the screen for everyone?
I'm going to share them right now.
Okay, thank you. Okay, so if we just move to the next slide, slide 2, and we'll kick off there. All right, so tax residency. So if you are departing Australia, generally the most important thing to consider when making the move to Israel or even elsewhere around the world is what is your tax residency status going to be? And the reason for that is the Australian tax system principally operates on the basis of tax residency and source of income. So if you are an Australian tax resident, you'll be taxed on your worldwide income, whether it's from sources in the US, Israel, Australia, you'll be taxed on it. If you cease Australian tax residency, then as a general rule of thumb, you will only be taxable on Australian sourced income. And so in the context of making the move to Israel, where you're looking to take advantage of various things, including, the 10-year tax-free concession that Harel will speak to, being a non-resident of Australia becomes critical because if you're generating foreign sourced income, so income from outside of Australia, it may not be taxed in Israel and it won't be taxed in Australia. So that's obviously a big advantage. In terms of tax residency, there are 4 different tests, which you can see on the screen in front of you. If you satisfy any one of those tests, then you will be a tax resident of Australia. So it is important that when you're considering your departure, you do get advice because it is quite easy to satisfy one of those tests. It's a lot harder to cease tax residency than it is to commence tax residency. And to give you an example of some of the steps that we often advise clients to take, you'll need to sell your home, or you'll need to, at the very least, rent it out on a long-term basis so it's not available to you for your use when you return to Australia. You'll need to sell your car, you'll need to cancel your gym memberships, you'll need to take yourself off the electoral roll, cancel Medicare, so on and so forth. We do have a tax treaty, and I'll come to that, which does look to relieve instances of double taxation, but it's not always perfect. And if you do make the move and you are ceasing residency, you need to make sure that you monitor your facts and circumstances constantly. It's not just a once and for all test when you depart. It is an ongoing analysis that you'll need to conduct, because if your facts and circumstances change, so too may your tax residency status. And critical is documentary evidence. Okay, the onus of proof in Australia for taxpayers is for taxpayers to prove their tax residency. If the Australian Taxation Office believes that you are a resident and continue to be a resident of Australia, even though you're predominantly living in Israel, if you can't produce the evidence to refute that proposition, then you will have a problem. So evidence is key. And just finally on this slide, the government did announce changes to the tax residency rules in the 2021 federal budget. The idea was to move to a simplified bright line test whereby residency would be determined on a day count basis. That has yet to see the light of day. It's not clear whether it will, but it's going to go through a significant consultation stage. So I don't expect anything to happen in the very near future. Thanks, Pearlie. Happy to go to the next slide. Okay, so what to consider when you leave. There are various consequences when you cease Australian tax residency. One of them is you are deemed to dispose of your capital assets that don't have a connection to Australia, very simply put. Now, that can lead to issues of unfunded tax liabilities. So let's just say you held shares in BHP and Bloch, and you were sitting on a pregnant capital gain of $5 million. If you cease Australian tax residency, you'll be taken to have disposed of those shares, and you will have a $5 million capital gain that you'll have to pay tax on, even though you haven't actually realised those assets and brought home the cash. Now, there is an option in that context to choose not to have that rule apply. The consequence of that will mean that those assets remain in the Australian tax net, so that when you do eventually sell them, they'll continue to be taxable here, as well as potentially taxable in Israel. So that is something that, in advance of ceasing tax residency, you need to understand, because if you don't want to choose for those assets to remain in the tax net, then you need to start working out ways of how you're going to fund that tax liability if you're not going to be liquidating the portfolio. Another downside of ceasing tax residency and being a non-resident is that you lose the benefit of the CGT discount. So for those on the call here, you may be aware of the benefit of the CGT discount, which is when you hold a capital asset for more than 12 months, you generally reduce the gain by 50%. So you're only taxable on half of the gain. So if you've got a top marginal rate of 47%, your effective rate of tax will be 23.5%. Now, that discount does not apply for non-residents, so that is a downside of ceasing residency and continuing to hold capital assets that remain in the Australian tax net. The other very important consideration as well, sorry, Pearlie, just still on that slide, is that non-residents aren't eligible for the main residence concession. So if you are looking to cease tax residency and you don't have plans to come back to Australia and you currently have a main residence, it will be very important that you put in place steps to sell that prior to ceasing tax residency, because when you do, the main residence concession is not just not available, but it's not available on the whole gain. So you don't get a pro rata exemption for the period that you were an Australian tax resident. You lose the concession entirely. So it is important that you take steps to sell before you leave. And then finally, you need to consider what other structures do you have in place? Have you got a company? Have you got a trust? And if you look to move to Israel and suddenly those entities are controlled out of Israel, is there the consequence of those entities ceasing residency here and becoming residents in Israel? Or are they dual residents? So are they residents in Australia and Israel? And then you need to turn to the tax treaty to resolve any double taxation concerns. Thanks, Pearlie. We can flick over to the next slide. Okay, so you're in Israel, you've ceased tax residency. What happens? What are you taxed on now as far as Australian income is concerned? So if you continue to receive dividends out of a company that you're a shareholder in, then there will be no tax in Australia where the dividend you received is fully franked. If, however, the dividend you receive is unfranked, then there will be withholding tax of 15%. So let's assume you receive a dividend of $100, $15 will be deducted for withholding tax, and you will receive the net amount of that. That is a final tax. So if that's the only income you receive in Australia, there will be no requirement to lodge a return in Australia to declare that dividend. It's simply withheld at source. The same principle applies for interest income, except there's a reduced rate there of 10%. And there is also, for less relevant in this particular context, but royalties as well have a withholding tax of 15%. As far as income that you do continue to receive with an Australian source, where there is an ongoing obligation to lodge a tax return in Australia, that will be broadly everything else. And some examples there are Australian source rental income. So if you've retained an investment property in Australia and it continues to pay rent, that will be accessible to you, assuming you hold the investment property personally. And you will need to go and lodge a tax return and disclose that income in Australia. So it'll be important that you maintain, your relationship with your accountant. The same can be said for a capital asset that's sold. It will continue to be subject to capital gains tax in Australia, but you may not get the benefit of the discount for reasons explained earlier. And then finally, with trust distributions, if you're an Israeli resident as a beneficiary receiving a distribution from an Australian trust, the trustee will have a liability and will need to withhold out of the trust distribution an amount of tax and remit that to the tax office, but the beneficiary will continue to have an obligation to disclose the amount received in their Australian tax return, and they will get a tax credit for any tax paid by the trustee so that there is no double taxation. Okay, moving on. So just briefly, I mentioned earlier the Australia-Israel tax treaty. We do now have a treaty. I think it came into place in 2019. And, the underlying purpose of a double tax treaty is to simply avoid double taxation, as the name suggests. So there may be instances where, you remain an Australian tax resident, but you're also an Israeli tax resident. You'll need to have regard to the treaty to determine where you are taken to be a tax resident for treaty purposes, so that you're only being taxed once and not twice, and that one of the countries is giving you a credit to ensure that there is no double taxation. The same issue of dual residency frequently comes up for companies as well. And I think Harel will touch on the issues arising for Australian trusts where you've got Israeli beneficiaries. In terms of the withholding tax rates for dividends that I mentioned before of 15%, that comes from the tax treaty. So there are various different types of categories of income that will be covered under the tax treaty to alleviate any adverse double taxation concerns. We can move on to the next slide. Okay, so just briefly, because trusts typically come up for myself, and I'm sure for Harel as well, when advising Australians, including Australian trustees, where they've just simply got Israeli beneficiaries that may already be in Israel and not part of the 10-year tax-free holiday period. So for Australian resident trusts, if the Australian resident trust is generating foreign-sourced capital gains, then where those gains are distributed to a non-resident Israeli beneficiary, those gains will continue to be taxable in Australia. And that's the result of a full federal court decision a few years ago. That can be compared to a situation where if instead that foreign-sourced gain was the result of an asset that was held by the Israeli beneficiary directly, it wouldn't be taxable. So there can be a mismatch in terms of what is taxable in Australia depending on how you hold the asset. And as I say, if it's an Australian resident trust holding an asset that generates foreign-sourced capital gains, distributing it to an Israeli beneficiary, it will still be taxable in Australia. And to top that off, you will not get the benefit of the discount. In terms of distributions from Israeli resident trusts, so let's assume that an individual has gone off to Israel, has ceased residency in Australia, has also caused their Australian trust to become a non-resident, then to the extent that there are amounts of income being generated in the Israeli trust going forward, which are distributed back to Australian beneficiaries in the future, there are various provisions that will seek to tax those amounts, depending on the nature of what it is that has been derived by the trust. So continuing to maintain trusts, whether an Australian resident trust or whether a trust that becomes an Israeli resident trust, will involve inherent complexity. And you will need to make sure that you work through that carefully to understand what's in and what's out of the Australian tax net. And if we just go to the last slide. So just to summarise very briefly, I've got a minute left. Were you a resident for tax purposes when making Aliyah? What are the consequences of ceasing tax residency and how do you do it? That's really the first question to ask. What are your structures? Do you have companies? Do you have trusts? If so, how do you maintain those entities being Australian tax residents? Or should you take steps to wind them up? Or should you take steps to have them cease Australian tax residency and instead be taxed in the Israeli net? That's something that you need to get advice on clearly, and it's something that you need to get advice on from an Australian advisor and an Israeli advisor working together so that you understand the holistic picture. What's the income that you're earning going forward? Is any of it Australian sourced? If so, there may be continued Australian tax filing obligations. Do you have capital gains? If so, you may lose the benefit of concessional tax rates associated with those gains. Do you have superannuation? How are you going to make contributions going forward? You need to make sure with an SMSF, for example, that you only have a director that's an Australian resident. So you'll need to put in place appropriate measures to ensure that you comply with the superannuation rules. And just finally, for some of the younger people on this call, if you continue to maintain a student loan debt and you make Aliyah, there will be ongoing obligations depending on your income levels to repay your HEX debt or other associated loans. So that's the full picture, and that's 15 minutes, so I'll hand back over to Darren and Pearlie. Thank you.
Thank you. I'm going to jump along and hand it over to Harel. Thank you.
Okay. Can you hear me, Pearlie?
Yep. Good to
Okay.
go.
Great. Hi, everyone. And good morning, good afternoon. My name is Harel Tow. I'm a co-head of international tax at KPMG Israel, based in Tel Aviv. And thank you, Gold Rock Capital, again for inviting me. We will spend now 15 minutes discussing a few topics. I will start by explaining in a nutshell about the Israeli tax exemption regime. What does it mean, and what are the opportunities or risks that are relevant to all of you that are contemplating on making Aliyah. I will then spend a couple of minutes trying to explain the main obstacles that we are seeing with, in facing Australian/Israeli trusts, and also trends that we experience relatively recently in that space. And I will end with a few tips for those of you who are considering making Aliyah in the relatively foreseeable future. So, as Darren indicated, Israel provides for a very significant financial/tax opportunity by providing a 10 years tax holiday exemption. Where the law currently stands is that for those of you who will transfer their center of life to Israel and will become Israeli tax residents for all intents and purposes by 31st of December of this year, they will have a 10 years tax holiday exemption and a 10 years tax compliance exemption. So effectively, there is no reporting exemption and no reporting liability, and no tax liability for a period of 10 years regarding foreign sourced income. For those of you who will make Aliyah and become Israeli tax residents from 2026 onwards, the tax exemption would still remain in place, but the reporting exemption will be cancelled. So in other words, you would still benefit from the actual financial advantage, but there would be a bit of a compliance headache to deal with. So what are we referring to when we talk about foreign sourced from an Israeli standpoint? If you have, for example, property in Australia, or foreign sourced dividends, foreign sourced interest, that would be fully exempt in Israel for a period of 10 years. I think we should differentiate between those of you who are at a more advanced stage of their careers or lives, and they come here and they will not work from Israel. In other words, they're not active in business, to those who are still employed, still active in business, because the tax outcome would be different. For those who are employed or who are business owners and they're still active in business, the source of the business activity that is rendered from Israel, or employment activity that is done from within the states of Israel, that in itself would be taxable. And I think that that's where most people get it wrong. They think, okay, 10 years full exemption on all type of activity. That's slightly incorrect. The foreign sourced capital gains, dividends, interest would still, in principle, be exempt. But if you are active in business, then I think that that's where more slightly complex structuring would be required in order to ensure that the Israeli tax authorities are getting the allocation that they are entitled to. It doesn't mean, by the way, that the entire structure would be tainted into Israeli taxation, not at all, but it should be done based on transfer pricing principles and economic grounds and so on and so forth. Moving to the long-term planning, the way that the Israeli tax exemption works is that, as I said, you have a full tax exemption for 10 years, but when you go out of the 10 years, then what happens. So for capital gains, the general rule is that there would be it's not a 0-1 game, there would be a linear proportion. So in other words, we would need to look at the purchase date and on the sale date and on the date that the individual got out of his 10 years. And only the proportion based on a linear formula, not based on valuation, would be taxed at capital gains rate in Israel. Obviously, there are strategies that could result in a step up in basis, but that's the general rule. When it comes to dividend distributions or interest income, that's a 0 or 1 game. So in other words, if you move out of your 10 years and you get a dividend, even if it is foreign sourced, you would be fully taxable in Israel. There is no linear basis for that type of income. Yeah, I think that's more or less about the foreign, the 10 years tax holiday period. Now, moving to the issue of trusts, okay, Australian Israeli trusts, as we are heavily involved with Australian clients and have been involved for many years, and obviously that's a very a challenging or a potential painful point, and that's where more proper structuring is required. Because Israel does not have an inheritance tax at the moment, and in the current political environment, it is not expected also for Israel to legislate an inheritance tax. It's for typical Israeli families. It's not a. I mean, we see trusts for family reasons, but not for tax reasons. Okay, trusts are taxed. The starting point is that trusts are taxed in Israel as individuals. Okay, so effectively there is no actual advantage in theory to operate via trusts. Now, the difference between the way that the Israeli tax authorities view trusts and the way that other tax authorities, like the Australian tax authorities, view trust starts with a definition of a beneficiary. As I've seen in many cases, and I'm sure the other participants here as well, it's a very common strategy in Australia to operate via a discretionary trust. Now, the challenge is that because the wording of a beneficiary, the way that a beneficiary is defined under Israeli law is so broad, then despite the fact that one may not have received a distribution from a trust, as far as the family is concerned, he or she are not even actually considered as a beneficiary. Once the trustee has the discretion to distribute to that person or subject to a certain condition, then generally speaking, that individual could very well be considered as an Israeli beneficiary, and that's where questions start to arise as to would that trust be taxable in Israel and to what extent. The law, which is relatively, I mean, it has gone through a few changes, but obviously it's not like we don't have hundreds of years of a tradition of trust. So the law provides for a relatively clear solution when you have an Israeli, like a new immigrant that came to Israel that is a beneficiary, as long as the settler, the economic settler, in Israel we always, as Darren indicated, we're talking about substance over form. So when as long as the economic settler of the trust is still alive, then potentially only the portion post 10 years of the relevant beneficiary would be taxable in Israel. But things become significantly more complex when the economic settler has passed away, and then one of the beneficiaries is making Aliyah. Where the law currently stands, there is no clear solution to that, despite the fact that it doesn't make sense for Israel to taint the entire trust and to tax the entire trust, despite the fact that the far majority, say, of the beneficiaries are still in Australia. I would say, however, that on the positive side, that the Israeli tax authorities are, I would say, more open or have been more open in the recent year or so to get to reasonable solutions, okay, surrounding that specific topic, either by way of a ruling or by way of informal opinion that they provide. So, and maybe that's already the next tip. I mean, Israel is different to other jurisdictions, and the way that we deal here with the tax authorities, it's very much of a face-to-face system. It's very legitimate and common for us to, pick up the phone or set up a meeting, ask our questions regarding a specific case, but on a no-name basis, without any specific reference to, to even to Australia or to the specific circumstances, in order to get their principal view. So it's definitely a common practice here. But maybe just to summarize the trust issue, it's complex, but I think that with the proper planning, there are solutions, and their purpose is not to tax anything. Basically, they just if there is a solution, then with proper planning, I think it's definitely achievable, either by planning or execution of certain strategies, if they work from an Australian standpoint throughout the 10 years tax holiday period, ideally, or in a discussion vis-a-vis the Israeli tax authorities throughout that period, or if need be, after the 10 years tax holiday period. Maybe just as a last point on that matter, generally speaking, the distributions from Israeli trusts are not taxable, with certain specific exceptions to trusts that qualify as a relatives trust, with a specific route that provides for taxation upon distributions. I think I have 1 or 2 minutes left, so just to share with you some insight about the what to do before you make Aliyah. I think that differentiating between or making sure that you are substantiating your Israeli tax residency at a specific time would be helpful for the longer term, in order to make sure that you know where you started, you know where you end, and you know when you are entering into the Israeli tax regime and finish your 10-year tax holiday period. In addition to that, for those of you who are involved with investments in Israeli technology companies, startups, etc., it's advisable to make those investments prior to making Aliyah, because there is a potential exemption, despite the fact that the underlying asset is Israeli, as long as you made the investment prior to making Aliyah. And I will maybe wrap up my part by echoing again that the 10 years tax exemption is here and is here to stay, but you should bear in mind that tax compliance here is a headache. I'm saying this as a tax accountant, so it's a headache, and therefore, for those of you who are heavily considering to make Aliyah in the coming months, say, or in 2026, there is an advantage to come sooner rather than later, in order to not to have a tax compliance situation, and burden vis-a-vis the Israeli tax authorities. And with that, I will hand it back to Pearlie, and thank you very much.
Thank you, Harel, Jonathan, and Darren. We are going to go into a few questions. I see some people asked in the Q&A, which is great. We're not going to be able to get to each of them, but we will answer them via email if we can, or we will happily direct you to the person who can answer the question. So we're going to start off with the question for Jonathan. That's okay. So the first question is, what happens if there's an Australian trust that sells a property and some of the beneficiaries are Australian and some are Israeli? What would the tax be in Australia?
So it will, I assume that in this example, we're talking about an Australian real property asset. So if that's the case, if there's any capital gain, it will be taxable in Australia, generally to the beneficiaries where they've been made entitled to the amount of the gain. If they haven't been made entitled to the gain, then the trustee will be taxed instead, but that's not usual. The distinction between Australian residents, though, beneficiaries and Israeli resident beneficiaries in that particular instance will simply be, one will be taxable and have access to the concessional tax rate for capital assets, being an effective tax rate of 23.5%. assuming the asset's been held for more than 12 months. The class of beneficiary entitled to that concessional rate will be Australian tax residents. The Israeli residents will be taxable, as will the trustee, and that's where I spoke about earlier. The Israeli beneficiaries will lodge a return and get a credit, but there will be no concessional rate. So rather than being taxed at effectively 23.5%, they'd be taxed at 47%. That's broadly speaking.
Thank you.
And I'm happy to answer the first question there from an anonymous attendee. Pearly, does this make sense?
Great.
Yeah, so you're asking if a trust based in Australia and there is a distribution to an OLE, do they pay tax on a distribution for the first 10 years? So generally speaking, no, as long as it is foreign sourced. And then even though there is no, if you're asking about clarify investment income earned in Israel for the first 10 years, so as long as we would need to understand whether it is foreign sourced or Israeli sourced. Okay, if you are a trader and you are based in like a proper trader, that's always the question mark. And you're based in Israel, and it rises to the level of a business activity rendered from Israel, then that would be taxable. But if it's a passive investment activity made, Australia, Germany, US, anywhere out of Israel, then in principle you would not be taxable in Israel. So I hope I answered that question.
Yes, thank you. I'm going to move over to a question to Darren. What percentage of an OLE's portfolio should not be in Australian dollars and should be in shekel or in US dollars or foreign currency?
Well, that very much depends on the size of the portfolio. Firstly, you need to make sure that you are earning sufficient income to cover your spending in Israel and to make any meaningful purchases. So you need to look out 5 or 10 years and consider what meaningful capital activity you would be doing in Israel, and then consider making sure that is linked to the shekel. Beyond that, in general, we would consider more than 50% Australian dollars for most, other than the largest investors, to be probably too much. Just it would mean that if there is a break in the rates, as we see, the best example I can give is what happened to people from the UK who moved to Israel at the time where the shekel pound was 8 shekels to the pound, and it dropped to under 4. That was a very, very meaningful and difficult change for people that made Aliyah from the UK and left most of their assets in the UK. And so not to rush the transition, but the transition should be made, in my view, for most people to above 50% non-Aussie dollar.
There are a few other questions. I think we will end on that note, and we will go through the questions as well, and maybe we'll send the Q&A with answers in the follow-up email as well. Of course, if you guys have
Pearly, maybe Harel, you can ask answer the question about property development and investment in Israel. There's the question about how to structure it for primary residence or an investment. How's best to structure those holdings if you're doing them in Israel?
For a residency, you mean?
If you're purchasing a residence in Israel,
okay,
or
yeah,
property development in Israel.
Yeah. So I mean, to relate to the personal real estate, residential real estate in Israel, first and foremost, we would not advise to actually buy it from a trust, because the only place in our Israeli tax law where there is a compliance requirement due to the ownership of an asset as opposed to an actual income generation is in the trust law, and therefore we don't like the idea of owning Israeli property via foreign trusts. For an apartment, where you want to live, I mean, we would typically buy it directly But obviously there are nuances, and definitely when it comes to property development, that's already a separate bucket that would need to be discussed separately. As Michael Slonim indicated, VAT perspective should also be considered, so that's a separate discussion.
And just to the person who asked about rates of tax in Israel on investments earned in Israel in the first 10 years. So there are various different rates. 25%, 30% tend to be the rates for income and capital, sometimes less if the asset is actually denominated in shekels and non-linked to CPI. But they tend to be in the, as a sort of rule of thumb, think about 25 to 30%. Harel, you want to jump in on that?
Yeah, that's generally the rate. Now they've increased the surcharge to up to 5%. So you may as well consider like an additional 5% on top of the 25/30 on passive investment. It would be subject to your ownership in the structure.
Yeah,
but it could go. Yeah.
The surcharge is effectively a surcharge on the wealthy. So it is for it applies to income above, I believe it's 750,000.
More or less, yes.
More or less.
Passive income, yeah.
Passive income in shekels. So any income earned above that will be subject to an additional 5% on top of the regular rates. Okay, I think that we're basically done then. Thank you very much, everybody, for attending. As Pearlie said, we will send an email out shortly with contact details for Jonathan, Harel, myself, and a little bit of additional information. And please feel free to contact any of us or Pearlie if you have any questions or want some guidance. We're all here for you. So thank you once again to Arnold Bloch Leibler, to KPMG Israel, and to the Israel Chamber of Commerce, and to all of you for attending. And as next week it is Yom Ha'atzmaut, I will take the opportunity to wish everybody a Yom Ha'atzmaut Sameach. It should be a happy Yom Ha'atzmaut and a wonderful year for all of us and for the state of Israel. Thanks very much. Bye-bye.
Thank you.